Good morning, good afternoon, good evening, ladies and gentlemen. I know we have quite the global audience today, so thank you for taking the time out of your busy schedules to join our webinar today as we discuss the various aspects of the economy and the indicators and shifts that we are on the lookout for. I'm Cam, the resident financial analyst here at Dunhill Financial. I'm sure I've had many an email exchange with you in the audience, so I know I'm not the only one when I say it's finally nice to put a face behind the name. Myself, along with Isa, will be the moderators of this webinar today, with Brian as our star host of the hour. We will be putting everyone on mute as soon as the presentation begins. Please feel free to ask any questions in the chat to myself or Isa, and we will do our best to answer them for you, or alternatively interrupt Brian to get his thoughts on the matter. Just before we start, a few disclaimers to go through for compliance, so just bear with me. Dunhill Financial is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale, purchase of any specific securities, investments, or investment strategies. Investments may involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or a tax professional before implementing any strategy discussed herein. And with that out of the way, I'll hand it over to Brian.
Forgive the technical difficulties there. Many of you know the story of Christopher Columbus back in 1492 and how he ended up sailing to find and found the New World. Another story that goes along with it leads towards the story of the egg, of which Christopher Columbus went around Europe and spoke to all of the different monarchs and challenged them to find a way to have that egg stand up straight. He got to King Ferdinand, and King Ferdinand took him up on the challenge of if he could get it to stand up on its end, he would fund the expedition west. Christopher Columbus was creative and crushed the egg, essentially allowing it to stand up straight. A creative alternative. Now, this is how Benzoni told the story in his book, The History of the New World, back in 1565. There's a lot of more interesting and scientific versions of this, but essentially, for the sake of our story, what we care about is that he found a creative solution to the problem. And that's what we want to go over today. Essentially, I apologize. I seem to have the wrong presentation up, so bear with me for one moment. My apologies, everyone. We just had changed these, and therefore we have a new version, and I didn't upload them. This will only take a moment. So, on the creative thinking approach, what we're going about is we're looking at companies. Many of these companies that essentially are in a position to think creatively with the current parameters. Now we should be on pace. Now, essentially, there's a lot of companies that are growing in this pandemic. Some of the names that you see up here are the obvious ones, but even fast food deliveries or companies like Slice in America that are helping little local pizzerias are thinking outside of the box in how to deal with the pandemic. And therefore their revenues are actually growing and they're gaining market share in this market environment. Companies like Zoom, which have been around for a decade, have now become common everyday parts of our daily life. Shopify is becoming the biggest contender to Amazon with over 1 million stores served, to where a lot of you might have bought Shopify products without even knowing that you had them. But getting to these creative thinking companies is going to be key to navigating this market environment. And that's why we wanted to start the whole presentation with creative thinking. Different sectors have performed better at different times. And that's why many of you have heard me say that it's like nails on chalkboard when I hear politicians saying that this is an unprecedented moment. It isn't an unprecedented moment. Essentially, we've seen many of epidemics, pandemics, financial crises, and the likes over the course of history. And the one that has the nearest parallel to today is the 2003 SARS epidemic. And we like to compare this because we can see that certain sectors like healthcare, technology, and consumer staples should do better during a pandemic. But what you will find is that during this pandemic, we know that healthcare is the #1 sector, technology #2, and consumer staples #3. Why are we concentrating on the technology players? Because past precedents shows that those continue to grow after pandemics are over with, whereas healthcare and consumer staples revenues should fall back to normality. So we want to concentrate on that technology sector and those winners that will continue to win after this pandemic. We also want to look at all the data of what is concentrating people's minds. And we cannot forget that we are in both the year of Brexit and a new US election that is going to be just as bad as the last one. And that is what's taking up people's minds. Only #2 is the health and medical situation. But with the global pandemic, that is something that's going to truly affect the global economy. It's truly going to affect the stock market, and the politics is going to be noise around the center because the consumer is going to be key in the recovery, and we don't know the key variable of when they're going to be dealing with things. So right now, we have to break it off into a tale of two cities, essentially Wall Street and Main Street. Wall Street being the equity markets and the likes, Main Street being the mom and pop, the general economy that's out there. And they're diverging at fast paces. Again, this is completely precedented because in every pandemic, in every epidemic, the rich get richer, the poor get poorer. This is not what we're rooting for. This is just the reality of how it plays out. And in this situation, it's playing out in completely that way because what's happening is that essentially a local restaurant is struggling to get funding, even when there's government programs at this point in time. Whereas Wall Street companies, through government programs where interest rates are going down, and yet they're buying, whether in Europe, in the UK, or the United States, as much debt as they can, any of these companies can issue excess debt to fund the ongoing solutions going forward. So a company like Carnival is able to get $3 billion worth of debt to finance and make sure that they'll still be surviving even once this pandemic has played through. Big hotel chains, big restaurant chains like Darden have been playing in that same approach. And that's to where we have to remember that there's a large segregation of the stock market and the general economy. That's going to continue to be the case, and it's going to continue to frustrate most analysts and a lot of you as clients. And that's why we wanted to make that one of the big cornerstones of this presentation. On top of that, we have this odds lots theory. I've talked to many of you about the odd lots theory, but in a little tongue-in-cheek type of way. You know, there's two big things that have led to surges in trading on Wall Street. The first one was the shutdown of sports pretty much around the world, led to some teams out in Eastern Europe getting a bigger fan base than they'd ever imagined. But it's also estimated by the Financial Times that 780,000 typical gamblers shifted over to the stock market and started speculating there. Then the fact that a lot of people were home from work and had some excess cash because they couldn't go on vacation, they couldn't go to dinner, they started speculating in the markets. And that led to the odd lots theory. The odd lots theory is a theory that Warren Buffett has written about several times. And it basically states that what the individual small investors are doing is the exact wrong thing to be doing over the course of time. And we had many examples of this over the last couple of months with companies that have gone bankrupt, like Wirecard and Luckin Coffee, or Hertz that went literally bankrupt and yet got bid up by the purchasers on Wall Street. So we have to pay attention to what's going on there. You remember on the last newsletter we talked, or one of the last newsletters, we talked about Zoom, that so many people were buying the wrong Zoom and it bid up a stock significantly. So we need to make sure that we're looking beyond the noise and that we understand how to navigate through these markets. So where is the recovery? Well, the recovery in the stock market has really been concentrated in the United States. And there's been two big reasons why we've had a recovery in the United States beyond everybody else. The first, everywhere else, sorry. The first reason is simple. Essentially, in the US, we have a safety in that currency because it is one of the global reserve currencies. We're going to be talking a lot about that later on in the presentation, and that's something that's core to protecting our assets going forward. But the other element of it is that 25% of the United States index is now made up of technology companies. And with those technology companies, we want to be in that forward-looking thinking, and that's to where they've been leaders going forward. But we have to talk about the commodity markets. It's been a very controversial time in the commodity markets, especially when it comes to oil. We've seen oil go negative, which is just like interest rates going negative in the last couple of years, something that's unfathomable. But when it goes negative for a short period of time, and we should be more questioning where it goes from here. Because we've had a rebound from those negative numbers, but that is mostly a derivatives transaction, and that gets us back to where we were just pre-crisis. So we're back to more normalized levels, but what we care about is where's oil going long term. And that's where $40 just doesn't seem like enough. And that's where I take the guidance of the ones with the most know-how because they have the most oil. They have their consortium in OPEC Plus, and they use that consortium to control the volumes in the overall market. So when we look at what they did, they just issued a big IPO late last year. And that IPO money is predominantly going towards diversifying themselves out of the oil business. Now, knowing that they know more than us, and therefore not trying to overcomplicate this, if they're trying to diversify themselves out of oil when oil's near an all-time low, do they think that the long-term perspective on oil is good or bad? I would say it would be flat to negative. And that's to where I'm just using that as a simple gauge to say, how do we get out of being so dependent on oil in our portfolios? It was one of the leading portions of the S&P 500 for such a long time, but it hasn't been for the last decade. And this is perfectly aligned with our 5-year initiative to become more socially responsible in all of our investments. And as you can see, it has worked out quite nicely. When we look at the perspective of ESG and removing energy stocks from our portfolio. Without those energy stocks, essentially, we're looking at outperforming in 1 year, 3 year, 5 year, and 10 year, going backwards. And on the premise that the biggest investor in oil, the biggest company in the world, is divesting themselves slowly in a small amount, say 30 billion, essentially, we feel that we're more comfortable removing oil from our portfolios than having it in our portfolios. So that talks about some of our feelings on individual stocks, that we should be concentrating on forward-looking companies that are looking at creative solutions, that we don't have to be dependent on how COVID-19 plays out. We also think that the commodity sector is going to slow down because we don't feel very optimistic about the overall general economy. And that leads us to, what are the economic indicators saying? And with these economic indicators, well, a few things are positive, i.e., this has been the quickest recovery that we've seen. And that it gives us some peace of mind that things should come back in certain ways. But it's not all perfect, because the main reason that the stock market's rebounded so quickly is because the Federal Reserve has invested so much money in the market. They've literally bought up all these bonds, and you can see that huge spike in what they own on their overall balance sheet. So this is a little bit of a loan by the general economy, but it's helping because car purchases have increased, a lot more so in certain countries than others, but you see it across the board that we're rebounding somewhat. On top of that, we're getting people back into the hospitality industry, not at the same pace that we had, but at the same time, we've been able to generate some growth in certain industries, like some of the delivery companies. HelloFresh, Blue Apron, Amazon hired 175,000 people for their deliveries. And also do it yourself. So companies like Home Depot and Lowe's are benefiting from people getting into those industries. But those are a few of the nice pieces that we like to play with. And that's to where we want to concentrate on what a leading indicator is instead of just a lagging indicator. Those past three are lagging indicators. They're telling us how the economy performed. We like to really use commodities as a view of how people view the economy in the future, i.e. a leading indicator. And that's where copper, oil that we talked about earlier, have come off their bottoms, but they're nowhere near their highs. So we're going to be watching and talking about commodities a lot going forward to gauge what companies might be doing in the future for employment, because you've seen a lot of controversy when it comes to the numbers, and you see why there's a lot of controversy. Our last financial crisis in 2007 took a long time to get to big drops in employment numbers. This time it happened very quickly. We're getting a quick recovery, but it's going to be the momentum that we're going to really care about. And it's not across the board that we're seeing unemployment. You can really see that most of that unemployment's come from the leisure and hospitality sector. And they're going to be hurting for some time. So some of this will be a movement of certain sectors into others. And we'll have to see how dynamic the employment sector is going to be to get back to normal. With all those economic indicators, as you can tell by how quickly I've been going through them, there's only one economic indicator that really matters right now, and that's COVID-19. And I know everybody's been following this, and I know I keep repeating this chart, but Atish put together a great chart that shows us when countries are actually falling off that exponential growth curve. And I think this is a great opportunity for us to know what all this information, all this bad news that we see in the paper means, and why countries like Hong Kong, Singapore, China, and the likes are no longer on the trajectory and are back into growth. Europe and the likes are essentially in between to where we're in semi-lockdowns, and yet the populous four in Brazil, India, Russia, and the United States are essentially where we have the most fear. You can see them still in that exponential growth territory, and all four of them have come fully off their lockdowns and are pressured by other means. So the number of cases to us is not as important as the continued growth. What is the effect? Because 2 weeks later, typically we'll see the deaths coming about, and then we see the reactions of the consumers. So essentially, right now, we're still looking at a pretty low death rate to where people are denying COVID-19 being a problem. But if we continue at this growth level, essentially, when the numbers in the United States double, nearly everybody will have somebody in their network that's been affected by COVID-19. And that's when it doesn't matter what the politics come out to be. People's behaviors will change in a significant way on their spending patterns and the likes. So we've got to concentrate on that. We've got to follow it, but we can't control it. If we remember Stephen Covey's book, The 7 Habits of Highly Effective People, essentially the second rule is that highly effective people concentrate on the things that they can control, and they don't worry about the things that they can't. So we'll pay attention to it, but we'll find ways to manage through it. And that's to where we've got to look at these great opportunities in the next couple of years, and index reshuffling is going to be a big part of it. A lot of advisors and a lot of you are using indexes and exchange traded funds to buy those indexes. And some of these are going to have major reshufflings in the next years. I've talked a lot to you about the fact that China will be a big change for a lot of global indexes when all of their stocks are included in, but that is an issue that we'll be looking at going forward. But right now, we're talking about big changes in Germany, and we're talking about potentially a big change in the S&P 500, because the biggest car company in the world is not included in the S&P 500 because they've never had 4 straight quarters in a row with growing revenue. Now, that essentially means that if they're included, we could have a big change in how the index is concentrated. And those offer opportunities and problems for some other companies. So we want to continue to watch this group. After all, when we look at the top 10 companies in the S&P 500 in 1980, none of them are still part of the top 10 in the S&P 500 today. In fact, you'll notice that there's a few names from 1980 that you might not even recognize or have been more controversial in the last decade. So we don't want to be just stuck on what was good yesterday is good today. It's who's doing the creative thinking in the future, and building out the products that we'll be using in the future should be significant parts of our portfolio. Now, from all the talk, you've noticed the stock markets, to me, are more an opportunity than they are a threat. But there are threats out there, and the big threat is the US dollar. The US dollar in the last year essentially has given a nice smile. But that means we're sitting at high levels because of that flight to safety in the US dollar. And eventually that flight to safety is going to fall off. It could fall off because essentially the global economy starts to balance out, or other countries recover quicker than the United States. That's one scenario which we would like to see, because all boats rise in a rising tide. But the bigger fear factor is what happens if people lose faith in the US dollar. That's not what we're predicting, but we need to watch out for that, because things have changed in the US, especially in this last pandemic. And when we look at other currencies, you can see that Cam did a little bit of drawing for us today. And you can see what we have is that resistance line, and the euro is near breaking out of those limits. So we have to keep a good close eye on some of these foreign currencies that we haven't had to play it but one way, which was a strong dollar for near a decade. And now we should be looking at potentially having a weak dollar going forward. Even more so, you have countries like Australia, in which we wrote them off a few years ago because they're so dependent on commodity markets, and the commodity markets, as we talked about, have fallen off a cliff. But they fell off such a cliff, and it's been such a number of years that it's fallen off that cliff, that it looks like we've hit bottom. And as you can see, there's a deep correlation between copper prices and the Australian dollar. So again, the theme of this is that foreign currencies have started to show some resilience as they've come off the bottom. But the big question in global currencies is what's going on with China. Now, China has the Silk Road Initiative, and I'm not going to try to pronounce it, but I think, Cam, you can pronounce this, can't you?
I'll give it a shot. I think they pronounce it as Shiswazilu. So in other words, the Silk Roads of China.
It's always good to have people that are smarter than you around you. So the Silk Road has been something that we've been talking about for years. Actually, it's a term that we take out of history. Now, what we wanted to do is we wanted to unravel a little bit of the reason why these investments are happening. And a lot of it has to do with trade. That's undeniable. Naturally, every single major empire has always had great trade routes, and that is what has made them prosper. And there's no different right now with the United States having both the Atlantic and the Pacific Ocean to conduct business. In the history, 100 years ago, opening up the Panama Canal only increased that trade. But now with the Silk Road Initiative, the actual necessity of many countries to get access to funds has led to China funding countries inside of the EU, such as Hungary, and going as deep as the G7 by funding Italy on campaigns. And when they start funding projects in those countries, i.e. loaning them money, it becomes much more interesting when they're buying the commodities from these countries. And when we look at a lot of the Silk Road, they're buying commodities from Asian and African nations that used to be solely dependent on the petrodollar. So they'd have to, no matter where they'd be selling something, trade it in dollars. This is historic from after World War II, and one of the big reasons why the dollar got so strong. Now, if China is lending money to an African nation, but also buying one of their commodities in turn, there's absolutely no reason that China and that African nation should be trading in US dollars. They can instead start to trade in renminbi. It takes out one leg of the risk. The second big aspect that's changed is that at this point in time, China is no longer the biggest investor in US treasuries. It's back to being Japan. And based on that, if China is no longer needing to artificially push down the renminbi, and they're starting to sell off some of their US debt, the strength of the US dollar can dissipate at a good pace. And as you can see there, the US would have to come up with $1.1 trillion worth of new investors in the US dollar and treasuries. So it becomes very significant, and we've seen the renminbi hit a historic high in the last couple of weeks. So this progression looks like it's going to be a little faster. Now, we have to date back to 2008 in our last crisis. What happened? Again, along the theme of anybody that's saying this is unprecedented is just not looking at the recent history and the long-term history. In 2008, China made a push to become one of the global currencies, the global reserve currencies. This is not trying to dislodge the US dollar. So don't misconstrue it as a war of two powerful nations. This is just them stating we should have a place at the table. They failed miserably in 2008, so we can only surmise that they're going to make another run at it here in 2020. And as you can see, we have a perfect storm in cheap commodities of them selling off their national debt. And if people start to lose faith in the US dollar, that could actually progress their eagerness to shift towards another global currency like the renminbi, who's investing in them. So you can tell that the number one concern that I have of the 8 potential plunders of the world is a shift in reserve currencies. This would weaken the US dollar, and it would weaken 57% of the world's market cap in stock valuations. So this is not a prediction. I hope this doesn't happen. But if we don't have our eye on it, essentially this could come up and really surprise us. So we've got to get more used to understanding how China works, what they're doing, and how it will affect our overall portfolio. But we have other concerns out there. The US deficit is growing at a fast pace, and it's faster than usual because while we've been complaining about the US deficit for decades, it's typically grown in line with US GDP. So if the debt grows at the same pace as US GDP, it's just like having a bigger mortgage on a bigger house. It sounds worse when you look at it on a balance sheet, but on the overall balance sheet, it makes sense. Right now, we're going the opposite direction. GDP is shrinking, the US deficit is increasing, and there's no signs of that abating. For reason number 4, that a lot of people are talking about modern monetary theory. Now, they need to adjust this name because the origins of modern monetary theory date back to 1900. But the origins are simple. If we have cheap debt, we can finance whatever growth we want in the country through that debt. Now, sometimes that can lead towards good investments that lead to change. But other times it can lead to overspending and therefore the cracking of those economies. And that can really be exuded in examples from a lot of the old dynasties that fell apart because of overspending. And so we need to concentrate on that and not be stuck in the exuberance that the US will remain on top forever because of these types of shifts. We also talked about the Federal Reserve. The central bank is taking on more debt than ever before. And we have to remember the large taper tantrum that we had when the United States and the Federal Reserve started to try to reduce that balance sheet the last time. Now, expecting this time to be different is not something that we like to think about. So we need to concentrate on how they're going to control that balance sheet and what would happen if they can't control it. Naturally, 5, we talked about populism. Populism is a huge issue around the world, and it's not just amongst the big 4 in the United States, Brazil, Russia, and India. It goes globally throughout most all European nations, even here in the UK. And this is something that is leading to fast shifts in some of these events that we discuss. So paying attention to populism is going to be something that's going to affect our portfolios in the global economies. Anti-globalization is something that we're having to deal with for the first time since anybody studied Japan. And this is going to lead to shrinkages in GDP globally if we go towards more anti-globalization sentiment. These shrink our economies, and therefore they should be a concern when the populists lead towards an anti-globalization factor. And now we're looking at a multipolar world. We don't have the leadership that we've been so dependent on for a long time from the United States. And in fact, a lot of our leadership for technology and the likes is coming from Europe. They're thinking through some of these concepts. So we're going to have a segmentation of different parts of our global economy being dependent on certain countries and not others. And that is going to spread things in a smaller way. But we always have to be prepared for the next event. We didn't have one decade in the 20th century of which a major nation, a major democratic nation was not at war. And that means we should be prepared for the next pandemic, the next war, or the next major event that's going to affect us all. So we can't just think that we need to get beyond this problem. We need to be better prepared for the next problem. Sun Tzu said that war is won in preparation, not in battle. And I think a lot of us would agree that this pandemic has showed that we did not put enough preparation into what we would do in a pandemic. So how will we deal with that next event? We have to get in front of that.
Thank you for that presentation, Brian. And thank you, ladies and gentlemen, for attending our webinar. Now, just before we open up the webinar to our Q&A session here, we would like to leave you with a few thoughtful words. Now, Archimedes, who was a Greek mathematician and someone who I would argue is far better with numbers than me, indicated the importance of leverage. Now, leverage is also known as debt, and it's what's been keeping the global expansion going up until now. The reason we are concerned is that events that have unfolded in the globe are something to keep a watchful eye on. If left unattended, these could leave the framework of a strong recovery that many analysts are looking for exposed. So although this is no longer a credit crisis with the help of the governments and central banks, as Brian pointed out earlier, we still have these fears mixed in of a solvency issue going forward, which throwing money at the system is unlikely to fix, as we saw with the likes of Chesapeake, Hertz, and Wirecard.
At this point in time, we'll open it up for any questions that anybody might have.
Yeah, please feel free to type your questions into the chat box below. We'll also see if we can put everyone off mute, so you're more than welcome to voice out your questions to either Brian or myself. Please note we won't be able to answer any specific personal questions, but we would be more than happy to follow up in an email or a private call.
Seems that we have one, okay. Aha. What is our overall investment strategy? Well, essentially, we don't want to divest from equities at this point in time because right now the stimulus is all coming from our reserve banks. There's an expression that you never want to fight the Fed, and this to me is extremely important at this point in time because those companies are being stimulated by lower interest rates and by essentially a central bank that's buying up all of their debt. So with that, what we're trying to do is we're trying to build the best portfolios possible by finding the most creative companies out there and eliminating sectors that we don't feel will either survive or that we don't think will flourish in this type of economy. So we're picking on oil stocks for two reasons. As Chesapeake was one of the examples, essentially a lot of these oil companies are filled with debt. When I look at ExxonMobil, they funded their dividend over the last decade by taking on more debt so that they can continue paying out that excess dividend. To me, that's not a great way to run a long-term company in that format. So they're only dependent on oil prices going up at a significant level. We've also taken a little bit of a shift towards moving that energy money over towards renewable energy. And renewable energy sources are a great source for us because most governments actually have a law that states that renewable energy has to be used prior to dirty energy. Makes sense. Why would you waste the energy that's made by a solar panel or by a wind turbine to just go ahead and burn coal? So what we're finding is by buying a renewable energy company, we're guaranteed to sell all that energy even as energy usage has fallen off some.
Perfect. And I think we've got a slew of questions now. Finally, the audience is starting to wake up a bit. So we've got one from Yuka Kant. Technology investments seem strong. What about the problems with tech unicorns? How would you suggest picking tech stocks?
Most definitely. I think the tech unicorns are in one department, whereas a lot of the outperformance in tech companies has come on another side. Now, most tech unicorns to this day are still private entities. And even the ones that have gone public, we've seen some disasters come about from them in the last year. When we think of Uber, Lyft, when we think of WeWork, for example, these companies have struggled because they were going on what's called a blitzkrieg of throwing money to get as many clients as they can to go from not having an industry at all to being the only player in that industry. And that's to where that's a highly risky area in that in that venture capital segment. And we have not played in that segment at all. Not back then, not now, because we find that there's a lot too much risk for most of our clients' appetites. But when it comes to a company like any of the FANGs, Facebook, Apple, Amazon, Netflix, and Google, removing their ESG quotants, essentially most all of them will grow their revenues during this pandemic. And they will grow them faster than they would during a normal marketplace because people are so stuck on their computers at this point in time. And that would have happened naturally, but it's going faster because of the pandemic. So I think we can segregate those two. It's not to say that the whole tech sector is wonderful. It's to say that that grouping offers some opportunities that are decorrelated from the general economy.
Perfect. I think we've got a few more questions. We've got one from Richard Simpson. John Authors from the Financial Times says that the US tech share prices are moving into bubble-like territory. Is it time to get out?
So John Authors is spot on certain segments. And like I said, it's not across the board, but let's just take a company like Amazon. The question is no longer how much they're worth as one entity, but what happens if you break them apart. And again, on the theme of the day, let's use precedents. So when Rockefeller's companies got broken up, when AT&T got broken up, all of a sudden it unleashed a ton of value underneath. Investment bankers call this the waterfall segment of each different business line having a different valuation. And until about a decade ago, it used to be believed that a conglomerate had more value than when it was separated. So I would make the argument that if all of these tech companies get broken up, the FANGs, i.e. Instagram, WhatsApp, and the like get spun out from Facebook, if Amazon AWS gets separated from the retail unit of what we think of at Amazon, if the App Store, Apple gets spun off from the actual retail divisions, that they're actually pretty closely valued to what they should be at. But internally, there's a lot of risk in those companies if that doesn't happen because the valuations are quite high. So I think there's more factors. What he's saying is he's playing on one camp, but the variables in between are, to me, the interesting ones, and yet the growth is still there at many of those companies. I think I'll add one extra little thing, because I know John Authors wrote this a couple months ago. It was Bill Gross's old saying that right now sometimes we're looking out at all of our dirty laundry and we're looking for the least dirty shirt to wear. And so I'm not saying that I love technology at these prices. I'm saying it's the least dirty shirt of the bunch.
I think that's the perfect analogy to use in these times. So we've got another question from Michael Desar. How would we recognize the early signs of a big long-term fall in the almighty US dollar?
Oh, that's a wonderful question. And actually, Kim, as our resident chartist, I might actually ask you to jump on that answer.
Yeah, so you know, we've seen these shifts in regimes where we have currency strength, which leads to currency weakness, and so on and so forth, and it's more of an ebb and flow. For the most part, we've, as Brian mentioned, you know, in the previous slides, we've enjoyed nearly a decade of US strength, of the US dollar, you know, just going from strength to strength, rising, which has left, you know, a great part of the segment, such as emerging markets, you know, high and dry. So I think the first sort of signs that we'll need to be on the lookout for is how the emerging markets react, you know, especially with the Aussie dollar. You know, that's something I think both Brian and I were speaking of, you know, which surprised us quite, to be frank, to the upside. And, you know, if we start seeing these shifts with other currencies like the euro, like the sterling, like the Aussie dollar, you know, once they start breaking out of these long-term trends, you know, that's probably a good sign that, you know, the US dollar dominance is slowly fading. Not to say that it will go away in its entirety, but those are sort of the signs we should be on the lookout for.
Exactly. The leading indicators are those important factors. So all these pieces that we're talking about could be those leading indicators that imply that. And I think, Cam, you hit the nail right on top of the head with that.
Thank you.
Perfect. It looks like we have a couple more here.
Yeah, we've got one from Don Hughes. What about Wirecard AG and its unraveling? Fast-growing financial technology company?
Well, Wirecard, I think, is a little bit of a different story from some of the others, and it's not the only one out there. Chesapeake had some fraudulent activity by the CEO, and it was reported on over a year ago that he was selling, I can't remember if it was his artwork or his stamps or something ridiculous that an oil company should not be buying, especially not from their CEO. Wirecard, $1.9 billion disappeared, or did it even ever exist? Or, all these questions. Again, not to be repetitive, repeating Warren Buffett quotes, but I think he said it best when he said, you find out who's swimming naked when the tide rolls out. And the pandemic has been a rolling out of the tides to where essentially we're seeing what the reality of some of these companies are. And so, yes, we are finding some frauds. And you'll remember in the last quarterly review, one of the things that we really discussed was that we wanted to get out of highly leveraged companies because some of that high leverage was a necessity for them to grow. But other portions was just hiding their actual revenue growth. For example, Exxon that I just used, to continue paying a high dividend by using debt, to me, is not a great use of your balance sheet. So I think of Wirecard as those frauds that get exposed. In complete honesty, we were discussing Wirecard and why it was starting to show an attractive price. And as we kept discussing it, we couldn't figure out why it was dropping like a knife to the floor. And as our old adage goes, don't ever try to catch a falling knife. Until we figured out why it was dropping so fast, we didn't even consider it. And luckily, that meant that we were able to avoid a big fraud in that. So I don't think that this is something new. I think that this is the precedent, as we go back to that theme for the day, is that during bad times, when the tide rolls out, we find out who's swimming naked, and Wirecard was swimming naked.
Exactly. I think to add to Brian's point, going forward, we are going to see a lot more of these solvency issues where, companies that don't have the most stellar balance sheets, they're going to come to front and center where, we're going to find out how strong of a position they were in before and how strong of a position they are going forward. I think we've got another question from Hugh Nelson. It's worth noting that the Chinese foreign investments are falling, not rising, that they have a rapidly aging population, and they are now facing pushback not only from the US, but also from the EU and the UK, along with their neighbors in Asia. So they have some challenges to overcome in their quest to become the global reserve currency.
Hugh, I can always count on you to have a perfect question. All of that, 100% true. And I think when you look at the demographics, it's whenever we're looking at what's going on in China, we make the parallels to what was going on in Japan back in the 80s. We love these demographic issues of what population growth does at different times. And naturally, that one-child policy in China has affected their demographics and will continue to affect it going forward. That being said, the first thing that I'm going to identify in there is that they're not trying to become the only global reserve currency. They're trying to get a seat at the table. And so they're naturally not trying to dethrone the United States and have the United States trade their commodities or the likes in renminbi. They're trying to say to these emerging markets that have been underdeveloped and have been underwhelmed by policy changes in the United States and the likes, to basically say, hey, why don't you come to do business with China? That gives them more access and less volatility when it comes to their commodity markets, and it gives them a bigger seat at the table of that global reserve currency. When it comes to the EU policies, you might remember a couple of years ago, Luxembourg and London were fighting over being the European trade centers for the renminbi. Luxembourg won out on that, and now it's becoming a big trading function. So to me, it's not the question of will they get a seat at the table, it's how long and what impact will it have on the global markets in that way. Demographics will all play into it. Still, there's nearly half of the Chinese population that isn't exactly affluent. Some of that are because of their trends to what they do in the West. Some of that will be people that are lifted out in the continued growth. But China is one of the few countries around the world that's looking at having a positive year when it comes to GDP growth this year. So we've got to remember to have our eye focused on that. I hope that we're completely wrong on that, but we always want to have our eyes on the potential changes.
No, most definitely. We've got another question from Richard Simpson again. The Atlantic recently had an article by a well-informed banker saying that US banks have got around the legal challenges in the US designed to prevent another financial crisis caused by the over-leveraged banks. Specifically, the US banks are again repackaging junk bonds into high-quality investments, only this time it's not low-quality mortgages to retail customers, but low-quality loans to corporates. The writer says we should be scared. Should we?
Well, leverage, as Tim astutely pointed out in the final quote, is the thing that we fear the most. You'll remember our January beginning of the year note was all about leverage. It was all about the over leverage and how concentrated it is in the US. And yes, they've changed the names, but how they operate is still quite similar. Even when you come down to all these real estate companies breaking down rents instead of just mortgages, it has that eerie similarity to what went on during the 2008 crisis. So yes, these are all things that make us nervous, but we've reduced our exposure to banks. The exposure that we have to banks is more along the lines of service providers like PayPal and such. We love PayPal, we love Visa, we love MasterCard because they're not banks. They're essentially fighting the war on cash, which is still that same trend. When it comes to the Bank of America's, the Wells Fargos, and the JP Morgans, who actually had really decent earnings the other day, we're looking at them as we hope that they do well, but we just don't know what's on the inside. So you're not seeing us have a concentration on that. This has led us to invest in Europe and the United Kingdom using a lot of thematics being that we buy companies that have the higher growth rates instead of the ones that have the biggest market capitalization versus being passive in the United States. So essentially that breaks that down. Now Hugh is going to keep me to task and also mention Capital One. With Capital One, yes, they do have a banking division, but it came later on. Capital One started as basically a credit card company. And Richard Fairbanks, the CEO that founded the whole company, to me is a king of data instead of just being a banker. And there's a drastic difference between the two, because when you look at what they did with that, they first started by offering college kids loans to understand who was good with credit, who was bad with credit. Then they built by buying Hyperion, Norfolk Bank, and Chevy Chase Bank, all on the East Coast, a lot of capital so that they could increase their banking prowess into other areas. But that gave them the ability to filter who was good credit risk versus who was bad. Whereas when you look at the majority of other banks like Bank of America, Wells Fargo, and JP Morgan, they just look at it as being a middleman of buying a loan and then going ahead and selling it off to Fannie Mae and Freddie Mac. So I look at how innovative these leaders are and what they're trying to build. The product ends up being a little bit different.
I think we've got another question from Yuka Kant. Do you think there's a future in investing in e-money type of fintech such as Revolut and your TransferWises?
So most of these companies are still in their infancy. So you can only buy them if you're a venture capitalist and doing them on the private markets. Now, I personally use Revolut. We personally, as a company, we use TransferWise. We use these services, and they are big growth segments. Whether they'll be profitable as companies, we first have to wait until their books are actually disclosed and they become public companies. I tend to find a lot of these, they invest a lot of money to disrupt the overall markets, but because they don't own that actual business model, guess what? The number one banking app on Apple is actually JP Morgan's. it's not one of those fintechs, because JP Morgan has a much bigger service department to help through those issues. And for any of you that you've heard me pitch Revolut, I'll tell you, hey, if you have a compliance issue there, just be patient. It's going to take 10 days to resolve it. They're not known for those types of issues. So they either get wonderful ratings or horrible ratings. What their profitability will be once they come out, we'll have to wait and see. They could end up being the next Apple or Google. They could also end up being the next WeWork or Uber.
Exactly. I think it's down to the timing really of when they come out to market, and again looking at those balance sheets and seeing what their figures are. I think we don't have any more questions unless people are still typing those out.
Well, before you go through your exit words, Cam, I would like to commend Cam for, first of all, putting together this presentation and many of our other presentations, and also congratulate him on the fact that the newsletter Finimize has actually asked him to start putting together monthly events, of which we'll be excited to invite all of you to join us on those monthly events covering a slew of different topics. So I think it speaks to what great quality presentations he's been able to put on, and we very much appreciate that, Cam. So wonderful work on your part.
Thank you, Brian. You're too kind. Yeah, I think if we don't have any more questions, we'll be closing it out. Again, I would like to thank you all for attending. We will be ending the webinar here. But again, if you have any specific questions or you would like to get in touch, please feel free to contact us via email. I think if Brian gets those slides up to the contact details, all the respective details are listed there. And alternatively, please feel free to book an appointment with us, and we'll be more than happy to discuss those. Again, we will be sending out a follow-up email, which should have a recording of the webinar along with the slides, so you can review the material in your own time. Again, from the entire team here at Dunhill Financial, we would like to thank you all for attending, and we hope to hear from you all in the following days.
Thanks, Cam. Thanks, everyone. We'll see you soon, okay?